I wouldn't say it's panicky yet, but we're moving towards that. The market's reacting in a very real-time way. This is the best time to find, stocks that have been indiscriminately sold off. I suppose the biggest call we had to make was the rules of the game are changing and the framework of investing is actually changing.
Hello and welcome to Shared Lunch, brought to you by Sharesies. At Sharesies, we're on a mission to create financial empowerment for everyone, and that's why these conversations are so important. It's a chance to really dig into what's going on in the world of investing and share that with everyone. Today, I'm joined by Michelle Lopez, Head of Australasian Equities and Portfolio Manager at Pi Funds, and we're going to talk about what's going on in the markets at the moment.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Before we get started, I'd like to acknowledge the Gadigal people of the Eora Nation, the traditional custodians of the land where we're coming to you from today, and pay respects to elders past, present and emerging. Hi Michelle, thanks heaps for joining us today.
Hey, thanks for having me.
There's obviously a lot going on at the moment, but thought we'd just jump straight in and say, is now a good time to invest?
Look, it's interesting. It's an interesting time to invest, and it's probably the most unpredictable market that I've worked in, and I've seen quite a few corrections, having been in the role for a couple of decades now. So the one thing I'd say is we're all feeling pretty battered and bruised, to be honest, at the moment, just given the volatility that we're seeing, but by no means in kind of chronic pain as such. And it's been tried and tested and proven over multiple cycles and timeframes that indeed these are the times that prove to spin off the best opportunities, particularly if you are taking a bit of a longer term view. So the next 6 months, who knows, particularly under the US administration that we're seeing at the moment with all the policy changes that are coming through. So I think you do need to sort of sit back a little bit and keep calm in these type of markets, and really sort of think through when the dust settles. These are the times that opportunities present themselves and money is to be made. So I think it is an interesting time. I'm not calling sort of the bottom at this point, but I think volatility is definitely our friend, particularly the way that we look at the market.
And so how are the tariffs affecting sentiment? And do you think there's any curveballs for us to watch out for? You mentioned you wouldn't call the bottom now, but can you tell us a bit about that?
I think there's multiple parts to this. The very direct impact to Australia and New Zealand is actually quite minimal from a relative perspective. So if you think about tariffs, and for Australia, our biggest export to the US is beef. And for context, that's about $1 billion that we export. You compare that to iron ore to China mostly being 85 billion. So again, we're relatively immune from that perspective. But you have to think about sort of second order effects, and you mentioned sentiment, and it absolutely hits sentiment because everything you're reading, everything you're listening to is talking about this market influx, trade wars, and it really does hit sentiment. We also have to think about sort of second order effects, and I mentioned iron ore as a very big export for us, but behind that is LNG, so liquefied natural gas. And again, that goes into our region being Asia, but it is pegged to oil prices. So the pricing of those contracts, which are long-term contracts. So there are implications around what's happening more broadly to the economy here. But having said that, it also spins off opportunities. Because guess what? There's going to be a lot of China product hitting our market, and it could actually be deflationary for the Australian consumer, which is a good thing.
How would you describe the vibe of the ASX right now?
Oh, I wouldn't say it's panicky yet, but we're moving towards that. And every day you sort of wake up and you don't know what to expect because headlines or tweets or whatever it is, there's something new. And the market's reacting in a very real-time way. And you've seen it through intraday moves being huge. So I think everyone is quite nervous. Everyone is almost skittish in a way. So that's why actually the most difficult thing to do and the hardest decision is to just remain calm until we have a sort of a clearer line of sight of where we're heading. And, I think tariffs have been really well broadly broadcasted. Obviously, the extent of them haven't. But it's something that's been spoken about now for months.
Yeah, you're right. Like we've seen, we track investor sentiment through the quarters, and over the last few months, like since the tariffs have been being talked about, we have noticed investor sentiment kind of dropping into what's called like cautious territory for us. But, people are still buying and net buys across the platform. So for you, are you playing it safe or are you seeing those opportunities?
Look, I think a bit of both. So we are certainly seeing opportunities. But, one of the things that you've got to be really aware of is, yes, absolutely picking the right companies, which is our bread and butter, really from the bottom up and understanding the companies that we're investing in. In fact, the biggest downside risk I always say is not knowing what you're buying. Having said that, though, portfolio construction is equally important. And it's really important in this type of market that you've got a diversity of companies with very different earnings drivers. Not so much sectors, because sectors can be quite misleading. And why that's important is we don't know what pathway the economy will take from here. Predominantly the US economy, given it's the largest and it absolutely moves markets. Because that pathway is unclear, you need to have your defensive stocks, you need to have your cyclical stocks, and then you've got your growth, your compounders, and they're going to each be affected in different ways. So ensuring that is in play and you're not leveraging only one scenario and going hard into that, I think that's prudent. So I suppose if you want to say that's conservative. Having said that, though, this is the best time to find, stocks that have been indiscriminately sold off. We've got companies that are off 30%, 40%, super high quality businesses with actually quite resilient earnings, regardless of tariffs. That have come off just with market sentiment. And that's your opportunity right there.
And we've seen, people are seeing, their portfolios going down at the moment. And we're hearing, that can be kind of hard to see. We're all human. And, it's hard to kind of react to that. But anything about what investors should be doing at a time like this?
Look, I think it's a market cycle. And yes, the rules of the game are changing somewhat, and that's what's driving this volatility. But we will come through this. So I suppose the one thing I would say is have a time frame in mind. And if you can't stomach losses, over the next 6 months, I'm not sure why you'd be invested in the equity market. But if you've got a longer time horizon, if you've got that 5-year plus time horizon, again, I always encourage people to zoom out, because even in this really volatile period, if you zoom out, it almost looks like a blip. We've been on a trajectory like this over the last 5 years, and it's a small blip. And I'm not trying to say that you've got to go all in now. That's not what I'm saying at all. I think there are some very clear risks. And as I said, the rules of the game are changing and the framework of investing is actually changing. But yeah, I think just be aware that, this has been 3 months and you really do need, when you're investing in stocks, you really do need to take a longer time horizon.
And you mentioned, you've been in this industry for years now, and you would have seen, it's very normal that markets go up and down and respond to changes that are happening in the wider environment. Is there anything you're observing this time or about this change versus other times where we've gone through this type of volatility before?
Look, I think this one has been particularly interesting in that it's a bit self-inflicted. The most recent one being COVID, that was completely out of anyone's control, and we had no idea sort of the extremity of the impact that was going to have. And then the one before that was probably the major one, being the GFC. Having lived through that as well, there was financial system collapse almost. Whereas this time round, it feels like it's a little bit more man-made. And there could be a very clear off-ramp for what's playing out at the moment. And that's the difference, that there is a clear off-ramp. We actually don't think that it will be taken, which makes it a little bit trickier. But that would be the difference, I would say. And the other side of it is there is quite a bit of firepower left fiscally, stimulus-wise, that could be injected into our market if the need is there. Both in Australia, New Zealand. New Zealand just cut rates today as well. That they've been on that trajectory for a little while now. So there's definitely firepower that governments can sort of come out with to underpin the consumer.
And how about in the funds that you're managing? How are those tracking?
I'm responsible for the Australasian equity component of PI, but PI does offer a whole range of products, different asset classes and balanced portfolios as well. Obviously, the balanced portfolios have done much better than the pure equity portfolios. So the near term has been challenging. If you look over a longer time horizon, 2 years, 5 years since inception, our funds have performed well. They've outperformed their peers and their benchmarks over a longer time horizon. But the last 3 months have been quite tough, in line with markets. And
have you had to make any tough calls through that time?
I think I get to the weekend and I'm so fatigued by decision making. I tell my family, just make decisions that you want about dinner on your own. Do not involve me, because our day-to-day is all about decision making and making calls on the spot with the amount of information that we've got to hand. And when that information is constantly changing, it's very difficult. So I suppose the biggest call we had to make was, maybe back to your question around defensiveness. We run portfolios and we've got target cash ranges, and we brought our portfolio up to the highest sort of level of cash that we could own towards the end of, beginning of March, over the March period. And that was quite tricky because the market had already fallen, 5, 6, 7%. And at that point, we were kind of unsure. We hadn't had the big sort of day, Liberation Day out of the US, and we chose to lift our cash levels quite to the max limit. And that felt a little bit risky at the time because we would have not kind of kept up if the market was to rally. But it's also positioned us really well now because we're sitting on this dry powder with a large amount of cash that we can start investing slowly into those companies, those opportunities, which, are popping up now. So I don't know if that answers your question around a hard decision, but we've got to make calls every day around that and positioning, because it's very difficult to predict at this point in time, given all the changes. So it's more about being prepared. So prepared for those different scenarios playing out and ensuring that portfolios are positioned for that.
And are you observing any changes to where money's flowing with a result of what's going on at the moment? Like often in volatile times, people might turn to gold. Like, is that still the case, or like what are you noticing there?
Yeah, absolutely. Gold was the best performing asset or sector or asset class or whatever it's categorised as in March. Gold was up 13% and the rest of the market was down 5%, call it, thereabouts. So it's definitely held its status as a safe haven. I think a bit more longer dated though. There's been lots of different asset classes that have really attracted a lot of asset flow, and private debt is one of those. Cryptocurrency is another one that's gotten a lot of attention and started to see over the last 12, 18 months, institutional buying as well, not just retail. There's been a number, but I'd say defensives at the moment, gold, cash, you've certainly seen shift into that. But that's kind of normal. I think there's nothing that's screaming people are panicking in any way. It's just upheld its status as gold. And, it's a big one for the Australian market in particular, because the benchmarks that we're running our funds to, which is mostly the small ordinaries, 12% of that benchmark are gold producers. So it's a big part of our market, and it's held itself.
How about any other rare earth minerals?
Well, rare earths is interesting, right? Because China's just come out and banned all exports to the US. Why that's a big deal is they represent something like 70% of the rare earths market. And rare earths actually are strategically important because they go into the manufacture of a lot of these core, high-tech products, as well as renewables, and even defence. So it's actually a really important factor. And there's actually a couple of ASX listed companies that are probably now looking a bit more attractive. And Lynas is one of those companies. We don't own Lynas in the portfolios, but they're Mount Weld asset in WA. They're one of the world's highest quality rare earths mine outside of China, and one of the largest at scale. So I think that'll probably be a beneficiary of what's happening from a China closing their export market to the US. And then you've got a lot of more speculative names in our market as well. You got Arafura, Northern Minerals, I think is one of them as well, Linden Resources. So there's a couple of real specky names in there, but probably not part of the market that we're playing in. We take the stewardship of our clients' capital very seriously. So again, we've got to understand sort of the risk. And for me, that part of the market is quite speculative. So we tend to avoid it.
And how about as we look to areas of growth or innovation, like is there anything that you're noticing popping up there?
Look, there's the usual stuff that you can hear about every day around, AI or healthcare and gene therapies. But, yesterday actually, I came across a really interesting article, and it was an industry piece around decommissioning of a number of these oil and gas wells in the Bass Basin for Australia and the Western Australian Basin. And you wouldn't believe it, I didn't believe it anyway, there's about $63 billion worth of work to be executed decommissioning these wells. There's 1,000 wells that need to be decommissioned over the next 30 years, starting now. That has to be done in a safe and environmentally friendly way. And Australia's taken a lot of learnings of issues that have happened offshore. So they've put a lot of emphasis on doing this in an effective and safe way. So I actually think this is going to be a really interesting space. It's nascent at the moment. No one's talking about it. So for me, and again, just trying to understand who are the players in this market.
The space being the decommissioning, or the
decommissioning. So think about everything from going out to these offshore rigs. The wells have been plugged up, so they're no longer flowing from a gas or oil perspective. And how do you remove that infrastructure in a way and get rid of it? So we've got, recycling companies, Cleanaway as an example, that are playing in a very small part of that market. But given the sheer amount of work coming through, That's kind of a growth industry that I think there should be some key beneficiaries of that. So when I come across something like that, I look for, okay, so are there any barriers to entry, any licensing requirements that are required? What companies hold those licenses? And then the skilled labour. This is very highly skilled, who has that sort of labour pool that can execute on these type of contracts. So that's an area that just caught my interest. I was like, well, that's something I haven't even heard about. So I'll probably be delving into that in a bit more detail and see who the natural players are.
Yeah, it's fascinating because you kind of think of like growth and innovation being producing something new, whereas this is almost the opposite. Hey?
Yeah.
It's like
Yep.
how to...
It's at the other end of something, but and that's the thing.
It's so important and obviously huge health and safety impact.
Absolutely. And you're spot on. Innovation isn't just new. It's also, a whole topic around innovation. But, these microphones, as an example, the amount that probably innovation that needs to go into that, and who's got the IP, who's got the patent around whatever properties. Like it's everywhere. And if you're not thinking about it, then you'll be left behind.
And how about any exciting new companies? Are there any standouts in particular?
We've had very little new companies come to market, unfortunately. So there's no new kind of IPOs as such. We had a few at the end of last year.
Why is that?
So we had Simal, Kuskal. There was a couple. The problem with IPOs is you need pretty buoyant market conditions for them to be successful. And then investors also want to see success post-IPO. And unfortunately, that hasn't played out for the ones that broadly came to market last year. There's a couple of things there. Liquidity, particularly in the sort of small end of the market, is really important. And when you're going down kind of the market cap range and sort of the risk increases, you want to make sure that new capital being allocated, there's a risk-reward trade-off there. So that hasn't played out. Now we've got heightened market uncertainty. No company wants to come and IPO when there is investor... you need investor appetite to step in, right? And not just IPO, but sustain it post-listing. And then maybe venture capital are still quite willing to provide capital into the businesses. So I think it's kind of a combination of all. But there are two that have been sort of flagged, meaningful ones, being Virgin. Looks like that I'm not sure if it's still coming to market after what's playing out, but that certainly has been flagged. And then close to home as well, New Zealand Fonterra are it's a dual track process of a trade sale, but also IPO, the consumer part of the business as well. So they're probably the two main ones that I know of in the pipeline, but it has dried up. And that's not a good reflection, I suppose, because you want a real vibrant market, and IPOs are typically important because it attracts new capital, and given our specialty and our niche in small caps, it's been a big part of how we've invested in the past.
Yeah. And so I guess we'll just kind of start to wrap up now, but wondering if there's any message you've got to investors at the moment and how to kind of move through these times.
Look, I think there's a famous quote that's probably been rewritten a number of times and different people adding their own little way spin to it. But, I always think back to investing as a business is actually the only business that when it goes on sale, which is kind of what we're seeing now, that people run for the doors. And again, coming back to timeframes and coming back to understanding what downside risk is, and downside risk is not knowing what you're buying. If you do the analysis and you understand what the risk of those earnings are, I think these are the times that the opportunities present themselves. And sure, it takes courage, but it's been proven time and time again. So take advantage of the sale, I suppose, if you've got that time horizon.
Yeah. Hey, thanks so much, Michelle. Really appreciate our chat today.
Oh, it's a pleasure. Good to be here.
And thanks everyone for tuning in. You can watch Shared Lunch on YouTube or follow along on your favourite podcast app. Leave a comment or follow us and tell us what you'd like to hear about next.